Welcome to Looking at the Markets with David Modell. Market crash 2018. Will it happen? Will it not happen? Well, I'm not in the business of predicting, and so I'm not going to give you a definitive answer, but I can give you my best guess based on the facts. So let's start with a quote. This is attributed to John Maynard Keynes, an English economist. The market can stay irrational longer than you can stay solvent. Think about the people who've been shorting the market since 2009. How have they been doing so far? Well, not too well, all right? Yes, the market is expensive, but it can stay expensive month after month, year after year, and if you're shorting the market, it can stay too high or irrationally high continuously until you run out of money and go broke, and we don't want that, all right? And so I'm going to make a case that shorting a market that is expensive is just a recipe for disaster. All right. So let's look at some facts here. All right. This is from the wallstreetjournal.com. And we've got the PE ratio of the major indexes. And I'm going to focus on the S&P 500 as a proxy for the U.S. markets as a whole. All right. So according to the Wall Street Journal on this page, the current PE ratio of the S&P 500 is about 24.5. All right. And then we'll take a look at another source. This is multiple.com. They've got the current S&P 500 PE ratio as between 25 and 26. And then Barron's.com, this page here has the S&P 500 PE ratio currently at almost 25. So, 24, 25, 26. Yeah, they're all, I don't know which one's exactly right, but they're all a little bit higher than I'd like it to be, but it's not exactly bubble territory necessarily either. It's not like it was in the year 2000 or 2008 when PE ratios were out of control, valuations were way too high. The markets were very expensive, and it's okay for stocks to be expensive as long as the earnings or profits are also very robust. All right, but right before these market crashes, you tend to see not only very expensive stock prices, but also earnings that just aren't that great. All right, and so you get very, very high PE ratios. High prices for stocks and low or just not very high earnings, not high enough to justify the high stock prices. So the PE ratios right now in the S&P 500 generally are a little on the high side, but I don't remember. This doesn't feel like I remember it felt like back in the year 2000 and 2008. And if you were investing back then, I think you know what I'm talking about. I think you know what kind of euphoria people felt back then. Right now, the market is going up, but it's not parabolic. It's not going up like a rocket ship. It's just kind of going up gently over time. It's not like it's going up 20% every year or even 15% every year. It might end up going up 15% in the year 2017, but it has not been doing that every single year. In fact, in the year 2015, the market was pretty much flat. In fact, I think it was actually negative a little bit, if I recall correctly. All right. So it took a breather a couple of years ago. Let's take a look at market breadth. All right. Is there broad participation in these new all-time highs that we're seeing in the markets? In other words, is it just a small handful of stocks carrying the S&P 500 to new all-time highs, or are there a large number of stocks participating across multiple sectors? Well, this is from stockcharts.com. This is a chart this is a weekly chart. Each candlestick represents 1 week. Showing the S&P 500 percent of stocks in the S&P 500 above their 200-day moving average. And as you can see, look at it. There's an interesting double bottom here. But, it's chopping around, but it's not really, really, really low like it was back in, let's say, October, November, December 2016, January, February 2017. It's not low like it was here. It's actually, pretty close to the top, at least from the past couple years. So that means there is reasonably broad participation, not super broad participation, but enough. There are enough stocks above their 200-day moving average in the S&P 500 to make me feel, at least right now, that there is reasonable participation among stocks in the S&P 500. It's not just a handful of Amazons and Googles or whatever carrying the entire market. All right. And besides, even if we do feel that the market is too expensive, what are you going to do about it? What are you going to do about it? You're going to buy, what are you going to buy? UVXY? Here's UVXY. Okay. Here it is. Here's how UVXY has performed for people who held on to it. All right. Look at that. Started up here, down, 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 just continuously down. All right. So what are you going to buy and hold this thing? Really? This thing that's lost 99.99% of its value in the last few years? Here's another one, TVIX. Here it is, TVIX. Similar chart. Look at that. People who bought it and held it have pretty much gone broke. They've lost 99.79% of the value of their investment. It just goes down and down and down. So even if you did think that a market crash is going to happen in 2018, what are you going to do about it? What can you do about it? What's a reasonable investment to make? You going to short the market? You going to buy UVXY, TVIX? You going to short the S&P 500? Again, how has that worked out for people who've been doing that? Not too well. All right. So my answer to the question of, is the market going to crash in 2018? I doubt it. I really doubt it. I don't know, but I'm not into making predictions, but I doubt it. I don't see any serious red flags. I see an expensive market, but again, let's go back to the quote. The market can remain irrationally expensive longer than you can stay solvent. Okay? An irrational market can outlast your brokerage account, believe me, if you plan on going short the market. All right? And even more importantly, even if there were a reason to believe that the market is likely to crash in the year 2018, what are you going to do about it? There's no product out there that you can use to really safely short the market for any length of time more than a few days or maybe a few weeks. But to hold a product like that for months and months is, in my opinion, not a great idea. So even if you did believe that the market's going to crash in 2018, I don't think there's much you can do about that, except maybe hold cash. That's about the best you can do. And I don't necessarily recommend that either. I think it's best to be, invested in something better than nothing, because due to the forces of inflation, holding cash for months and months and years is not a great investment either, because the dollar is being devalued. Your dollars are losing about 3% per year of their value due to inflation. So look into other ideas besides shorting the market. That's my opinion, and I'm sticking with it, at least for now. All right. If you have questions, if you'd like some help putting together a trading or investing plan, you can contact me at any time. My name is David Modell. My email address is davidmodell@gmail.com. I hope I gave you things to think about with this, and I really appreciate if you would leave a thumbs up for this video, leave comments, and please subscribe to my YouTube channel if you haven't done that already. Thanks a lot. I really appreciate it, and I'll talk to you again soon.